Hi, this is part one of fundamental analysis. I'm going to start off with essentially a video from Jim Cramer, who I recorded years ago on some discussion of terminology. So I thought this would be very useful. So we'll go ahead and start with the video first.
But it can be a whole lot easier and much less daunting than you probably think with a little instruction. The whole business of managing your money is made much more confusing and difficult because of all the arcane terminology and authentic Wall Street gibberish you hear every day. If you're not clued in, it can sound like the pros are speaking an entirely different language. You got to remember that there's an entire industry of people who want you happily convinced that investing is too hard, that ordinary people just can't do it, and the safest thing is to give your money to a pro. Now, maybe that is the right thing for some of you, but if you put in the effort, if you do the homework, then you can do it, I think, at least as well as the professionals. The fact of the matter is that many of the pros are just about your fees. They're just about getting your fees. More interested in taking your money than making your money. And that often means keeping you ignorant about the market so you stay in their stock change. Now, look, their chains are strong. They're like the Wizard of Oz. They don't want you to peek behind the curtain. They don't want you to understand. Because if you did, then you'd take control of your own finances, pick your own stocks, and not pay someone else potentially exorbitant fees to do the things you're perfectly capable of doing yourself. And that's where I come in. Tonight I'm pulling back the curtain and explaining everything, because while authentic Wall Street gibberish can sound complex, even impenetrable, it's not rocket science or brain surgery. You don't need to go to business school or work in an investment bank to understand it. You can comprehend all the mystical sounding vocabulary that we all throw around as long as you have a translator, a coach like me, who can explain what the darn words mean. Think of me as a defector, someone who played for the other team, managing $500 million of already rich people's money at my old hedge fund, but is now playing for you, teaching you to navigate your way through the minefield of the stock market every weeknight here on Mad Money. Forget the Da Vinci Code, forget Enigma, forget even the novel code talkers. To be a great investor, you got to break the Wall Street code, and I'm here to help you crack it. That's why tonight, I'm giving you my Wall Street gibberish to plain English dictionary. Consider this a glossary of the most important terms that you absolutely must understand. If you're going to actively manage your own portfolio, words and concepts that many people in the financial industry don't want you to get your heads around, since that actually might make you feel empowered enough to pull your money out of their mutual funds, pull your money out of their coffers, and stop handing over your fees and commissions. Even if you're a pro, though, you may not know enough. So why not take advantage of my 30-plus years of investing experience to give yourself an extra edge? Let's start with a couple of extremely important ideas that go hand in hand: cyclical and secular. You hear these all the time, yet no one but me ever bothers to explain what they mean, even when they're crucial when it comes to picking stocks. Cyclical, nothing to do with a spin cycle in your washing machine, nothing at all. Or Wagner's ring cycle. Not necessarily my kind of classical music, but not bad. I like Goddard Damrung. And secular isn't about the separation of church and state or public versus parochial schools. Oh, yes. And a kudo to the late Lou Rukeyser, one of my idols, who first cracked that cyclical joke, and I always remembered it. We say a company is cyclical if it needs a strong economy in order to grow. It's cyclical because it depends on the business cycle. So steel producers like U.S. Steel or Nucor fall into this category. So do machinery companies like Caterpillar, Ingersoll Rand, along with the raw materials plays, BHP, Billiton. Chemical companies, Dow Chemical, PPG. That's that old Pittsburgh plate glass. These companies are all hostage to the vicissitudes of the economy. When it heats up, they earn more money and we're willing to pay more for their earnings. And when it slows down and when they shift into recession mode, they earn less money and investors pay less for their shares. A secular growth company, on the other hand, is one where the earnings keep coming regardless of the economy's overall health. Think anything you eat, drink, smoke, brush your teeth with, or use as a medication. So you've got consumer staple companies like Procter & Gamble or Colgate, the foods like General Mills or Kellogg, tobacco companies like Altria, drug stocks like Pfizer or Merck. These are the classic recession-proof stocks that you want to buy when the economy slows down and investors flock to stocks that can generate safe, consistent earnings. You don't stop eating food or brushing your teeth just because of a recession. Okay, so why is the secular versus cyclical distinction so important? Why is it the first piece of Wall Street jargon that I'm translating for you? Because it helps you figure out how much money companies will earn. And because it matters to the big institutional money managers, the guys who have so much money to throw around that their buying and selling drive stocks up and down, which is basically the single biggest determinant of where prices go in the short term. The whole hedge fund playbook is about when to buy and when to sell cyclical stocks or secular ones based on how the economies around the world are doing. This is what drives their decision-making process. About 50% of the performance of any individual stock comes from its sector, which is just a fancy word for the segment of the economy a stock falls into. Tech, energy, machinery, healthcare, finance. And when it comes to sectors, much of the moves are driven by whether they fall into the secular or secular camps. The cyclical, just so you know, cyclical means that it's going to be a camp that in this particular market is going to get hammered when growth slows. Secular won't really impact it. You don't want to own much in the way of cyclicals when the economy is slowing in general. These stocks are simply going to get crushed because their earnings could and often do fall apart. They can't make the estimates, as they have during every slowdown in the last decade, including these Chinese slowdowns. And there's nothing you can do about it. By the same token, when business heats up and the cyclicals are all doing well, nobody wants to own those boring, consistent, recession-proof secular names. They don't want secular growth like cereal, and you won't make much money in them during these periods either. Oh, and this can help you understand another needlessly opaque piece of investing technology, a rotation. That's just when money flows out of one of these two groups and into the other. And various verisimilitudes. There's little sectors within those big groups. Now, this is probably completely antithetical to what you've been told about the right way to invest. Conventional wisdom is that if you're going to pick your own stocks, something which, by the way, the conventional wisdom regards as being the height of idiocy, because you're not supposed to be able to beat the market, or you're supposed to lose money, then you should find high-quality companies and stick with them through thick and thin, and eventually, if you hold out long enough, you'll make some money. This is that brain-dead philosophy of buy and hold that I spend so much time trying to debunk. A zombie ideology that refuses to die, even though it's been utterly discredited by the market's performance. And I explain that in a bunch of my books, Real Money, Getting Back to Even. Those are all about trying to deal with volatile, tough markets that still, and what stocks hold up when we finally get back to even. Once you recognize how powerful the secular versus cyclical distinction is, you can see why buy and hold is just so darn silly. If you're going to own stocks through thick and thin no matter what, then you need to be prepared to lose money if the cyclicals when they're out of favor, or tread water in the secular stocks while the cyclicals are roaring. You got to be willing to take that level of pain. You may be in the wrong sector at the wrong time. That doesn't mean you should play the rotation game and only own the group that's in style. Not at all, actually. Remember the need for diversification, another important piece of investing vocabulary, which simply means not having all your eggs in one sector basket. To me, you're diversified with no more than 20% of your portfolio is in any single sector. That way you won't get annihilated if, or for example, a sector rotation takes down your cyclical stocks because you'll have some secular growth names that are holding up much better or even making you money at the same time. Diversification, free lunch. Bottom line, investing isn't easy, but it doesn't have to be mystified. You just need to learn the language, know the difference between cyclical and secular growers, recognize the sector rotation when you see one, and always stay diversified. Gary and Indy.
Okay, so we just reviewed some fundamental stuff, and let me go review it with you what he just discussed. Basically, we discussed cyclical versus secular, and the bottom line is cyclical requires the business cycle to grow to basically increase revenue and earnings. When the business cycle is going to be down, you'd expect these businesses to also drop in earnings and revenue. So, as he points out, a lot of industrial stocks, technology stocks, consumer discretionary things are all in this category. So things such as Caterpillar tractor, Deere industrial vehicles, auto sales, airlines, basically, all these are in a booming economy, basically have business. And all the associate suppliers to these main companies will also be busy. So you think of essentially auto companies like GM and Ford, and I don't know if I count Tesla in it, but at this point, GM and Ford, and then you have their suppliers who provides them the seats, the engines, the wheels, and all the parts to make the car. Those companies are also would be growing when these particular companies are in a growth situation. I put consumer discretionary obviously because when you have money, if consumers have money, they will go ahead and spend more on things. So things that are more discretionaries are like hotels where people will go there for vacation. Obviously going to Vegas would be considered a major piece of that. So entertainment and hotels and other venues. So hopefully you understand that these are essentially tied to the business cycle. Secular are things that do not require a business cycle, and the majority of those are in what we call the consumer staple stocks. Those are things that consumers need. Doesn't require a bull market for them to grow. For instance, they're mainly tied to population growth. So you think of, as he points out, toothpaste, drinks, PepsiCo, things like that basically are considered consumer staples. Cereal companies, um, soap companies, pharmaceuticals, etc., which is part of the healthcare. Uh, Other ones are like utilities. Utilities also are constantly growing because of population growth. So these are considered the secular stocks. Okay. Um, Next item we'll be discussing PE. So let me go ahead and go back to Kramer and we'll go ahead and review what the price to earning ratios are.
And that's the price to earnings multiple, often heard of as the PE multiple, or just the multiple. They all refer to the same thing, and it's one of the cornerstones of how we value stocks. In fact, when you hear talking heads pontificate about how some stock has become overvalued or undervalued, they're talking about the multiple. When you hear someone say that PepsiCo is more expensive than Coca-Cola, they don't mean that Coke is cheap because it's trading at 55, while PepsiCo is trading at, say, 65, just using a couple of prices. The share price tells you nothing about a stock's valuation vis-a-vis another stock. To make any kind of apples-to-apples comparisons, you got to take a step back. When you buy a stock, you're actually paying for a small piece of a company's future earnings stream. So to value a stock, you have to look at where it's trading relative to the others in the earnings per share category, which you'll often see rendered as EPS. And that's what the multiple allows you to do. Here's the basic algebra, not even math, that any fourth grader could do. The share price, P, is equal to the earnings per share, E, times the multiple, M. The multiple tells you how much investors are willing to pay for that company's earnings. We don't care that Coca-Cola stock might be at, say, 55. We care that it sells for 15 times earnings. We don't care that PepsiCo might be at 65. We care that it sells for 14 times earnings. So, or to put it another way, the multiple is the special sauce of valuation. The main ingredient in that sauce? Growth. How much bigger the earnings will be next year than they were this year, and the year after that, and the year after that, and so on. The stocks of companies with faster growth tend to get rewarded with higher multiples. Why? Remember, the multiple is all about what we're willing to pay for earnings. And the more rapidly a business grows, the bigger its future earnings will be. So let's take one. Let's say a fast grower like Chipotle sells for 24 times earnings. That doesn't make it more expensive than a slow but steady grower like PepsiCo at 14 times earnings. Chipotle deserves the bigger multiple because it has a much higher growth rate. 24% say versus PepsiCo's 8%. Now here's where it gets interesting. Multiples aren't static. In different markets, people will pay more or less for the same amount of earnings. When they pay more, we call that multiple expansion. And when they pay less, it's called multiple contraction. Two more terms that sound much more complicated than they really are. That's what hedge funds are trying to gain when they play a sector rotation. They don't want to be in an earnings contraction situation. Of course, the earnings aren't static either. When you buy a stock, you're either making a bet that the E or the M part of the price equation is heading higher. So what goes into the E, or earnings? How do you make sure that they're increasing and aren't about to collapse? Okay, here's some more vocabulary. When you hear people talking about a company's bottom line or profits or net income, they all mean the same thing. That's the earnings. We call it the bottom line because the number's the bottom figure on a company's income statement. To figure out how quickly a company's earnings could grow in the future, you have to look for clues when it reports its quarterly results. That's why I'm always telling you to listen to those darn conference calls. That means you need to look at the top line, another unnecessary piece of Wall Street gibberish that's totally interchangeable with revenues or sales, all mean the same thing. You want to see strong revenue growth, which tells you there's a demand for the company's product. This is ultimately the key to the ability of most businesses to sustainably grow their earnings long term. And that's why it's especially important for younger, smaller companies to have a fast-growing revenue stream. Oh, and investors will really pay up for what's known as accelerating revenue growth, the holy grail. We call it ARG, which means the sales are growing at a higher and higher rate. With a more mature company, it should be able to turn its revenues into profits by cutting costs, and then return those profits to shareholders in the form of a dividend or potentially a buyback, although dividends are much more attractive because they put money directly into your pockets, beyond the top line and the bottom line. It's also crucial to consider the gross margin, which is in no way discussing and not the least bit marginal. The gross margin tells you every what percentage of every dollar of sales becomes profit. And it's super important to figure out how much money a company can make. To figure out the gross margins, you have to consider the competition, the cost of production, the cost of doing business in general. Businesses with cutthroat competition like supermarkets or airlines, they tend to have terrible margins, while a virtual monopoly like the way Microsoft has on Windows has margins that are downright obese. In some industries, the margins can vary widely. Take the oil biz, where the margins swing up or down with the price of crude. Here's the bottom line. You need to know the vocabulary before you can evaluate a stock. When you're comparing, look at the price-earnings multiple, the growth rate, the top line, the bottom line, and most importantly, perhaps, the gross margins. After the break, I'll try to make more money.
Okay, so let's continue on. So he just discussed what I call the PE ratio, but he calls it PE multiple. Basically, you can look at it as the price, and if you bring this across over here, price equals the multiple times earning, or the price over earnings equals the multiple. Or as you'll probably hear it most of the time, it's the PE ratio. So instead of calling it the multiple, it's the ratio. Either way, they're the same thing. So again, the price is the stock price, earning is the earnings per share, and then the multiple depending on the growth rate expected. So on a high growth company, you would expect the multiple to be higher because you would earn more. So it's like, how many years does it take to return the price you paid for the stock? So for instance, if earnings is like $2 a share and the price is 20, you basically pay 10 times more than essentially the earnings. So you would expect the multiple of 10 be, for instance, the number of years it would take to earn $2 to get your full price of $20 that you paid for the share. So in a way, it's how quickly do you get your money back from paying for the earnings. So again, think of the price of the stock is you're paying for the earnings and how quickly you get it back. In the case of a strong earning growth stock that's constantly increasing, you would expect it would take less time. So that's why the multiple essentially would be much higher. So instead of a multiple of 10, as we had as the example I was just pointing to, you could have an example where the earnings can grow significantly that you would pay 25 times earning or something. Additional terms you heard him refer to. Other financial terms was top line. That's usually the revenue, and the reason again he calls it the top line is because in all income statements pretty much the top line is the revenue, and at the bottom line is usually earnings per share, or in some cases just earnings. What you really want to look at is earnings per share, because essentially there are many shares out there. So the valuation should be based on per share, not just the total earning. And the other term he uses was the gross margin. The gross margin essentially is the amount of profit you get from every dollar of revenue. So if you, for instance, have $20 million of revenue, and you basically have, well, let's go to the example. An example here, for instance, if you have $10 million in revenue and it costs you $8 million to produce that revenue, then you have a net gross profit of $2 million. So the percentage of gain from that $10 million of revenue you divide by 10 will essentially give you a gross margin of 20%. So the next $1 million of revenue you get, you would expect you get $2 million of revenue. Now part of this is important because many people will be looking at both the gross margin over time as well as the net margin. So the gross margin, if you look at it over time, If it's steady, then you know you have a consistent business model. However, if it's continuing to decline, then it would be essentially a negative factor for the future. So that's a very important thing when you hear companies talk about their gross margin. People are looking at, is it the same as it was the last quarter or the last year, or is it decreasing, or has it been decreasing over the years? So as you expect greater competition or greater cost in making the revenue, that the gross margin would be decreasing. So that's a factor that's important to follow. Okay. We'll get into the other factors of risk and reward. So let me go ahead now and we'll go into the website and actually talk about it. So let's go back to the accounts. So generally when you come into Charles Schwab, we've done this before, you basically will have essentially your account information showing up at the top. And here's your account, your personal value, and then you'll have a graph of your personal value over time. So here's your personal value over maximum time frame. It's used here. Of course, you could use 1 year, and it'll show you essentially the daily change. So this is the total personal value right now. Change was down $2,700 or 0.4%. The market was down about 1%. So the maximum change essentially is over the entire time frame. So you can see the price of the stocks or your portfolio in this case started here at 563. It's up to 590, up 32, which is 5% over roughly almost 2 years. So it hasn't grown too greatly. And again, these are the stocks. These are my accounts I have here. So let's go do some research. So you'll see at the very top you have your accounts, and if you run over the accounts, you'll have all this other availability to look at. The highlighted items are actually going to be tab areas for the next menu if you were to just select account. And again, and under these highlighted areas of these tabs, you'll see other things that you can pick from. So right now, account, you would have summary, balance, transfer payments, positions, portfolio performance. And under positions, you'll have the market value of them. And under history, you'll have transaction and realized gain. So if we go over to research, for instance, you see you have market research, learning center, stock research, options, mutual funds, bonds and fixed income, CD, and ETF or ETP, electronic traded products or funds. So we're going to do some stock research this time. So if you were to pick the stock, you'll see all these as a sub-tab to be picked from. So again, picking stocks. So you see your high-level menu of research. Your second highlighted item is stock. And as it comes up, you'll see the tabs. You have the overview, charts, screener, comparing stocks, Schwab equity, performance, and rating change. That's pretty much what you would have when you buzzed over essentially this area here. You can see these are the same items. Now we're going to take a look at, let's pick Lockheed Martin, LMT. So if you look at an individual stock, you'll see you get additional tabs for that particular stock item. If you want to change it, you can change the stock symbol up here, and you'll get basically the same items to select from. So again, the summary information. So you get a summary of the stock over the 5-year period here, and you also have being displayed on showing the earnings and dividends. So these are earnings and dividends, and if you run over them, it'll give you the values. And what's usually good is to look at the what was estimated to what was actual, so you can determine the amount of surprise. Obviously, the greater positive surprise, the higher the stock can move up. The greater negative, also the stock can go down. Doesn't always follow as such, because there are some expectations about the futures, but in some cases the earnings report, as they announced, the future earnings might not be as good as the current. So because of the pre-announcement, in a sense, of what they expect from the future, the stock can move up and down also, which is why Jim Cramer always suggests you listen to the earning report. Okay, so in this case, you can turn this off and you can just see the chart itself. So we'll get into more charting later, but this time we want to take a look at the earning statements, so income statements, I should say. So if you pick out the statements, you'll see the three common statements you would have. So you can see you get income statements, balance statements, and cash flow statement. Now, one of the things between international stocks and U.S. stocks is the requirements of reporting. In America, American companies have basically SEC requirements to submit income statements, balance, and cash flow statement every quarter. So because of that, you can have quarterly data to look at. And of course, they are called, the SEC call them 10Q for quarterly. And they have the annual statements requirement also once a year. And they are 10K. So you can see more of that on the company website. But part of this also is that the government require the 10Q and the 10K to cover different periods. For the 10Q, you usually require basically the last 4 quarters to be reported. So you can usually see the 5 quarters, the current quarter plus 4 additional quarters. And in the annual, they require essentially 3 years. So in this case, we're seeing more than 3 years, but most places will only report the 3 years. You can see you're actually getting 5-year reporting here. So you have basically the current year plus 4 previous year. And in this case, you can see there was some restated. So apparently there was some issues, and as a result, they had to restate the earnings. And again, the requirement is the 10Q must report it between 40 to 45 days after the end of the quarter. So generally you expect in 6 to 7 weeks after the end of a quarter that the company will report their quarterly earnings. And if you hear any issues such as a delay in reporting, that usually indicates maybe an issue with the accounting. And accounting issue means possibly numbers you have seen before are not going to be valid, or the current numbers are having some issues. And that can usually cause a stock to go down once you report an issue with not being able to report your income statements. Okay, so let's go back to the earning statements. So in the income statement, we'll look at the annual one. Again, the top line is your total revenue. And you can see from here, from 2015 to 2019, it grew from 40,000 up to 59,000. So you get an idea of what the growth of that is. The cost of revenue, you can see, is here. And again, the net between that and the gross revenue is essentially the income. So you can see the income here basically is the subtraction of or the operating income here is represented by the total expense taken out of essentially the revenue. So revenue minus operating expense gives you net income or gross profit. And one of the things you are interested in usually is how fast that grows. So there's actually my growth sheet that I use that I had provided in another uh, web another video. So let me go ahead and bring that up now. So to take a look at how fast that revenue was growing, this is an old machine, so it's taking a little longer to bring up. Okay, so that's the growth rate. So let's go back to the revenue. So you can see here you went from 40 to 59, which is essentially 50% growth. Another 20% increase. So that's over 1, 2, 3, 4 years. You had a 50% growth in revenue. So one of the ways I look at how fast that grow is, I can think of it as just a growth in the value. So again, you have your principal, and the principal would be the $40 billion. Your current value is like 59 or 60, so that's roughly 1.5. And that's over a growth rate of essentially 5 years. So if you look at the 1.5 and over 5 years, that's roughly a 8-9% growth in revenue. Now let's go do the same thing for earnings. So let's go directly to the bottom line, which is the earnings per share. So here's your reconsolidated EPS numbers, and you have your shares, and you have your basic earnings excluding and including special items, extra items. So let's say that's 10.07 to start with, going to 22. So that's 1, 2, 3, 4 years to grow to 22. So essentially, the value of 22 divided by the initial principal of 10 is a factor of 2.2. So if you have a growth of 2.2, and let's go back to here. So again, the value over the principal is 22 divided by 10, so it's 2.2 over, again, 4 years. So again, looking at 4 years and going to 2.2, you would be right in between this value of 2 and 2.5. So it would be roughly 21%. So your earnings growth has been roughly 21%. So that's pretty significant and pretty good growth. So that's why the stock had moved up significantly. So that's a good thing. Let's see, what else do we want to know about this? Yeah, you have multiple items essentially in the earnings. So again, under the earnings per share, they provide a weighted average for the shares for that year. And you have the diluted also earnings. So in the diluted earnings, they include essentially additional shares that are options for the executives and others. So you can see you had an average of 282 million shares outstanding. It basically had a 284, so it's got an extra 2 million shares that are outstanding that could impact revenues per share. So as a result, you can see the earnings per share would be diluted slightly. And this is usually important for some of the high-tech stock back in the 2000 period, where there were essentially a significant amount of stock options for executives and others that could impact the earnings. If you think about it, you could have potentially another 30-40% of shares that will come up as incentives for the executives, and that would significantly impact the earnings for the total company, as the company will have to pay them as well as you, and as a result, you get a diluted amount of profit. So I think that takes up most of the earnings stuff. Another thing I would point out in here, of course, is you also have your earnings. Again, under statements, you got balance and cash flow, but I would think the cash flow would be the only other thing you'd be interested in. And if you find something unique that might be of concern, there may be some items such as here we have extraordinary item that you wish to understand why that was there. And there may be some footnotes also. In fact, the earnings report are usually done on two things. They are basically audited independently, and the auditors usually provide what is called a qualified or unqualified. So if the earnings of the auditor basically is unqualified, it means that there is no special circumstance that created that earnings. If you get a qualified auditor report on the income statements, it means there are some exceptions that they had to include to basically get the earnings report, and they may be of concern. So generally what you want is an unqualified. So the auditor, if they provide an unqualified earnings report and audit information, it means everything is kosher and everything should be good, and there is no special issues to be considered. If it is unqualified, there may be items that they are questioning and they have concerns about. And so whenever you get an unqualified earnings report from the auditor, you really want to look into the footnotes as to what they are. And you'll find issues usually from people if they are not unqualified and they are qualified earnings. Okay, so another thing is, again, Yahoo provides a lot of information. And again, they also provide an income statement, and again, you get the same thing. What you get here is TTM. So if it is not at the end of the year, in this case, this happens to be February, so it had already gone past the end of the year, they use what is called the TTM, or the trailing 12 months. That's to give you a more immediate look at the company, not just at the latest quarter or at a past year. So if you think about it, if it was in September, you probably don't care what the last year's data is. You really want to see what it's looking at right now. So if you look at right now, you basically look at the trailing 12 months. Because this is the end of the year, you can actually have this in this column, and it's only a matter of interpretation of why they don't put it there right now, since it is in February. And again, you get your reporting of earnings per share, your basic and your diluted. So again, you really want to look at diluted earnings to see if there's a significant difference. Here there's about a 14 cents difference, so it's less than a 1% delta, so it's not as much of a problem. And again, the weighted shares, 282 million is essentially the typical share. If you look at the fully diluted, there's an extra 1.8 million shares there. So that is essentially the income statement. And again, you can pick quarterly or annual. The other thing that is of interest essentially is going to be for the analysis for future, because what we just shown here are known data that are basically provided by the company to the SEC and everybody in the world knows about. What generally is more interest is what's going to happen in the future. So the analysis here provides essentially future projection of things. And again, they would always qualify in statements that these are just guesses, they are not promises of achievements, but it is what the company or the various analysts expects to happen. So again, if you look at the analysis, you can see the earning estimates, and it has the current quarter. It gives you the number of analysts, gives you the average, and gives you the high and low range of it. And then it will give you the year ago earnings per share. So you can see how it's changed. And then you have the next quarter, same thing. And again, you have the current year. So these have basically the current quarter estimate plus the next quarter estimate, as well as the full year estimate. And you would also have the next year estimates. So you have 2-year projection as well as 2-quarter projection here. So in this case, go back here, you can see the estimate is for $24.26 for this current year of 2020, with a next year growth of $26.55. And that is essentially roughly a little less than 10%, so say 9.5% increase. And as you can see from our earlier look when we used the growth rate spreadsheet, sorry. The growth rate was previously roughly a 22% growth over the last 5 years. So it looks like it slowed down to about 9% in earning growth in the future years. Now, you only see 2 years here, but if you were to use a Charles Schwab, and they have their projection also. So if you were to look at the earnings report here, or earnings data, you would see the earnings that are actually reported to the SEC, but you also get some estimates. So if you look down at the actuals, these are the actuals, so you can see how they actually grown. And you also have the price of the stock, so you can see right in here the price started to drop in 2018 to 2019. And before then, it was growing quite nicely, but it was only in the last year or two things started to decelerate. So you can see this looks like a significant growth. However, there's a significant hit here. Looks like they probably took a write-off or something, so they took a earnings per share hit. It was expected to hit $13. So $13 to $17 would have been a reasonable growth of about 20%. So that's why I say I was calculating roughly 22%, and it looked like it was growing around 22%. However, this year, it was only like 10% growth. So again, growth had significantly gone down. As a result, the stock had also gone down, but there were other things going on too at this time. So let's look at the estimate. So if you look at the estimate, with Yahoo, you saw there was a 2-year projection, 2020 and 2021. With this, you see the same thing, roughly 2020 and 2021. However, if you have other brokerage company or other data to provide more data for you, I actually have E-Trade that actually represents 5 years. So I would have 2022 as well as 2023. And that will provide me a greater visibility of the future, much more long term. So at least from this point, you would think that your growth rate is only was 22%, 20% range, has now dropped down to roughly a 10% range. So that could be an impact to the stock, and I will get further into the earnings per share growth rates and how to value the company in a follow-on. So in the meantime, this will be the end of the part 1, essentially, of the fundamental analysis. Stay tuned, and I will put together a fundamental analysis of part 2, which will discuss the growth rate as well as the PEG ratio and factors that goes into evaluating future growth of a company. Till next time.